Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is May 31st edition of Market Outlook. Don't forget to sign up for this free video and text newsletter. Get it weekly for free by going to www.marketgauge.com and entering your email, and we'll send it to you every week. Anyway, um, extreme choppiness in the market, a couple of interesting crosswinds, a little bit of a focus on some of the metals and that area of the market. There's some interesting news out that continues to pervade the market, even as it sort of goes sideways, and that's in gold and silver, and we'll get into that in a moment. So, first of all, I'd like to just take a look at our website here, marketgauge.com, because there's some valuable free resources that is also indicating some interesting things. One of this is if you go under resources and a little big view, you'll see the market overview section, and you can see here the accumulation days versus distribution. When you get 4 distribution days over a couple week period, that is definitely a sign for caution. And you can see the diamonds, or the Dow, has had 4 distribution days over the last couple weeks, has the weakest performance across the board. Of course, all of this performance here, with the exception of NASDAQ 100, is pretty marginal. But you can note here that NASDAQ in pretty good shape, but diamonds are really on the verge of showing some institutional distribution here. So anyway, that's a key factor that we're looking at. Let's go into our normal review of the markets. Okay, spiders. Um, Spiders basically put in another new high and paused and failed, opened with a pretty sizable gap down earlier in the week, bounced back up, and of course closed weak, but again still over the 50-day moving average, just closed under the 10. You can see the volume in the spiders still coming in more on the downside, hardly any accumulation days or real accumulation where you're getting greater than average volume than the prior day and above the norm. And as you can see, volume is pretty much drying up except on those big down days. So that's definitely a pattern. Now, in terms of directional movement, if we look at the weekly charts, you can see we're really not overbought nor oversold, but this indicator down here is your average directional indicator, and it is at extreme lows. We got even further negative, or what I would consider in terms of any type of directional movement, hitting basically new lows again, certainly in quite a number of years on a weekly basis. So that's really telling you that this sideways compression is just building and building and building. It also is making it quite difficult for any sort of momentum traders to get any traction, with the exception of some of the leading NASDAQ stocks, which continue to fly. So it's a very, very, very narrow gain in terms of advanced declines in the marketplace. So if you look at DIA, quite a different story on the daily charts. Let's take a look there. Hold on one second. Let me move this around. Okay, on the daily charts with DIA, notice the difference that we had between the spiders and DIA. Here you go. we closed basically right on the 50-day moving average. So, I mean, we have been traversing the moving averages back and forth, but clearly, after we attempted to put in that new high here, uh, basically paused, had a pretty nasty little sell-off here, and this is clearly the weakest index. So we definitely want to watch here. Any further weakness below the lows of Friday could definitely mean that we're in for additional rough sledding, maybe even a test of the 200-day moving average, or at least the lower end of the Bollinger Band, which is another 250 points or so down in the Dow from here. So again, market not overbought nor oversold. The breadth indicators are pretty much flat, and you are not getting any forward momentum. Another weaker index, which has been sort of one of the other concerns that we had in terms of the overall momentum of the markets, is IWM, and that basically closed under the 50-day moving average. So the IWM is clearly the weakest, DIA following. The Qs, definitely the strongest index. Look at this. Right, we did have that inside day, try to resolve to the downside. Still not all that much momentum. Weren't able to take out the lows of the outside day, and we're well above the 50-day moving average. Although we did find a potential resistance point here as we closed on new highs last week without much follow through. So the other indices, the other U.S. stock indices, dragging its feet. However, trends overall still intact with very slow progress at all. And basically, things are pretty much, it's up slightly on the year in terms of absolute performance, but relatively flat. In fact, this has been the tightest compression since the 1928 in the Dow. So that tells a pretty good story right there. Okay, let's move on. And I'm missing my... Okay, here we go. All right, so let's talk about volatility. This is looking at short versus longer term volatility, with looking at 1 month versus 3 month. It was frothy, as you can see. This chart here gives you your key levels. Now, what's interesting, we hit as we closed on new highs, extreme levels in that ratio, which means frothiness. And the markets paused and did sell off a little bit. But here we have, going back pretty much to the beginning of 2015, with the one exception of the January lows, that we're basically at a level of support on this volatility measure. So it'll be interesting to see, obviously, if the Dow could break down beneath that 50-day moving average. It looks like you're going to get a shot and an increase in volatility, and probably a decent sized move. On the other hand, this is where support is found. So it's going to be very interesting to see how the market plays out here around the current level. So Dow is your canary in the coal mine for the downside. If we break and take out that 50-day moving average and the lows on Friday, probably could be an indication of more sustained downside movement. On the other hand, looking at the Qs and a breakout to the upside there would be your key leading index for potential reversal, finding support at this level here in the volatility index, coinciding with a breakout to new highs in the Qs. So follow the strength, follow the weakness. The strongest index is the Qs. If it gets above the highs the last couple days, could get some nice follow through. On the other hand, the reverse is true too. So with all this compression, definitely sitting on a pinhead. Let's look at absolute volatility levels. As you can see, we definitely were at the bottom end of the Bollinger Band. Extreme frothiness indicated we broke back inside the band, but and with a little bit of downside follow through in the market. But again, not that much fear in the market. So that's an interesting indicator. Obviously, if we can get above the 20 level, I'd be more inclined to use that as a confirming indicator on a potential sell-off. So definitely let's watch the VXX. It's interesting because it really hasn't responded very much at all to the sell-off. Now, obviously, it's a pretty modest sell-off, but still 1 or 2% with a short-term pattern, you might have expected some more. Okay, bonds. We covered bonds last week. You had a pretty good upside move. Remember, we were focused on two things. Number one, the long-term the longer term and the intermediate term moving averages on the weekly charts certainly indicate that the long-term trend in bonds still intact, and it was oversold. We got a nice rally. However, on the daily charts, we basically got pretty close to this 200-day moving average, which is the green line. So you had a nice rally last week, as we expected. Ran into some resistance on Friday, right at the 200-day. So in this type of scenario, I would expect possibly some more upside action. You've got resistance both at the 200-day and this declining 50. So to me here, looking at the longer term trend that's still intact, wouldn't be surprised to see a little bit more follow through until it finds resistance both at that 128 level where it should really hit absolute resistance, but more likely you've got this sharply declining 50 at around the 126 level. That should prove to be a cap, at least temporarily, on the upside. So again, long-term trend intact, found some resistance at the 200. This looks like to me to be a buy weakness, and follow using OR reversal patterns as the bonds find some support on sell-offs. That's that's the overall picture, because again, the contradictory nature of this being in a distribution phase while the longer term trends are intact, that tie goes to the longer term trend that is strongly intact. All right, couple interesting things on the global stock market. This is EWL, and this is Switzerland. So this is a 20-week moving average. As you can see, the market basically tried to take out highs going back quite a while. And what's interesting here is Switzerland is most tied to the gold standard. So what is interesting is that there has been some talk, as I mentioned in the text, about certain countries wanting to repatriate their gold reserves back home or move them around, basically taking inventory. So it's not surprising that the one of the countries with the least amount of paper printing, Switzerland, acting well here. And in fact, if you go back, you're basically at close to all-time highs. So the couple week sell-off here still pausing at support level. So we're closely watching Switzerland to see that as sort of a harbinger of the nervousness of the market about fiat currency. and it's interesting that money is certainly flowing into Switzerland here. Although you did have a little bit of a spike on volume to new highs, the pause on light volume here. So definitely keep an eye on Switzerland. That's interesting uh, country to watch at this point in time. Now, a couple of other things. You can see that, let's take a look at China. Where are we with China? Okay, here we are. China, obviously one of the strongest ETFs, strongest countries, got really hammered last week as the government tried to reduce some of the frothiness, but they're sort of in a little bit of a bind. They've got to lower their rates. They're still on a relative basis have high interest rates, and they've been trying to lower it. On the other hand, they do not want to encourage too much speculation in the markets. So as you can see, still a good move up. It's paused here. It'll be interesting to see if the market recovers. The overall trend, China well outperforming every other market index when measured over the last 6 months or so, even though we had this pretty substantial sell-off in the past week. So money moving around. That Switzerland definitely looking pretty good. However, China on pause at the moment. And any continued weakness, it should find some support around that 46 level, which is the 20-week moving average. Okay, next we're going to review interest rates and risk. Right now, TLTs basically outperforming the SPY. TLTs are outperforming the junk debt and emerging market debt, which is basically a more cautious tone here in the marketplace. Same thing with high grade debt, high yield debt, corporate debt right here. As you can see, bonds or U.S. treasuries are gaining. The 20 and 30 year are gaining on junk, emerging market debt, high yield corporate debt across the board. You can see that the red line here crossing under the green, which is the ratio of the moving average, telling you that money is moving in more into U.S. treasuries, hence that rally last week. But again, the overall ratio between all of these instruments relatively flat. So overall, the appetite is about unchanged, maybe slightly negative for the risk on versus risk off. But again, the key thing is that ratio has been in a relatively tight range. So the perspective of the participants here in the market, the smart players, are that risk levels remain about neutral for risk on versus risk off as compared to last week. All right, last thing is looking at gold and some of the leading stocks. The fact is that gold has definitely sort of been in the headlines here in a subtle way, in the fact that certain countries want to repatriate that gold. One of the things I like to look at is some of the stocks in the gold complex. And one of the interesting things is one of the worst performing stocks has been getting into basing action and long term as well. So Newmont Mining, which is not considered one of the best mining stocks, however, as of recent, take a look at the weekly here. The weekly of Newmont gold relative to gold bullion itself, or the gold ETF. You can see Newmont down here on a weekly basis, definitely, basing out and getting stronger. So if you have interest in trading the gold sector, or you think it's about to turn, following the leading stock in GDX, which is the gold mining index, might be the way to get the strongest player in this sector of the market. And again, looking at the daily chart here, you can see gold itself. This is the gold chart itself, relatively flat to sideways over the last 5 months, where Newmont definitely, after a protracted down move, you can see Newmont way down, even on a ratio basis, now starting to turn. And look at this basing action here. If we can get above the recent highs, you could say that a bottom is in place and you're ready for a sizable move to the upside in this particular stock, which has never been a favorite of the gold bugs and gold miners. But things do change, and obviously this basing action is quite interesting. So I mean, take a look at the GDX, which is the mining index. Again, Newmont still outperforming the mining index as well. So this is GDX versus gold. Slight improvement here on a weekly basis. So if you're going to play gold, the mining index, which has been bombed out, definitely basing looking stronger, and the strongest stock in the mining index is Newmont. Okay, I hope this helps. The overall perspective of the market is still more sideways action. The overbought and extreme frothiness through the sentiment indicators are saying have eased up. Meanwhile, the overall trend is intact. The Dow and IWM looking a bit weaker than the Qs and the SPYs. Qs look to the upside. Breakout for follow through the DIA on the downside. And let's watch Newmont Mining as a harbinger of what may happen in the GDX, or the gold mining index, and the precious metals as well. All right, that's it for now. See you next week, and good luck with your trading.